Welcome, everybody. We're so glad that you have taken some time out of your day to join with us today. This is another edition of PWL Live. We've been doing these live webinars over the last number of months, and just love getting to connect with you and just engage around these topics: financial planning, investing, that sort of thing. And so today is Investing 101 for Financial Literacy Month. And so we're excited to maybe take it back to basics a little bit today, get into some fundamentals. So we're glad you've taken the time to join us today. Gonna just take a quick minute to introduce myself and my co-presenter. We'll do a little bit of housekeeping and then we will dive in. So for those that don't know me, my name is Phil Briggs. I'm one of the financial planners and associate portfolio managers here on the team at PWL. I'm coming to you today from my home office, which is just north of Toronto, where it is a snowy winter wonderland today. First real taste of winter. So, which I'm sort of happy about. I guess it looks nice from outside my window anyway. And my co-presenter today is Melissa Laursen, who's a financial planning associate and investment advisor at PWL. Melissa, do you have anything else you'd like to say to our lovely audience?
Yeah, I was just going to say it's sunny and green out here outside Ottawa right now. So I thought we were getting a little snow this morning, but it's cleared up. So it's a beautiful day here and just really excited to talk about investing with everyone. This should be great.
Awesome. Awesome. And so for those that don't know or maybe less familiar with our company, again, we do work at PWL Capital, which is a financial planning and wealth management firm. We work with families across the country to help them plan for and manage their serious long-term money. If you are interested in learning more about us or exploring more of our content, learning about, again, pretty much any topic when it comes to money, I highly recommend checking out our website, pwlcapital.com. That's where everything is consolidated. You can find a number of different blog posts, white papers, YouTube videos on things like technical investing in the markets, but also other topics like goal setting or the intersection of money and happiness and how those two things integrate with one another. So highly recommend checking that out. Now, let's get into some housekeeping for our presentation today. Melissa's going to tell you about Mentimeter.
Yeah, and even just before I mention this, we do have a couple colleagues, Kelly and Louie, who are in the chat. So you may have noticed that Kelly has already shared the link to our site if you want to check out some of those resources. So feel free to post in the chat throughout the webinar today. We will do our best to pause and to answer your questions. But like I said, we also have our two colleagues who can help to answer questions as well. And the other way that we really want to make this more interactive is by using a tool called Mentimeter. So you can scan the QR code that you see on your screen, or you can go to menti.com and enter the code that you see here. That's going to allow you to engage with our slides as we go. So we have some questions that we're going to throw out to you to learn a little bit more about you, our audience, and what it is you want to hear about, what sort of a situation that you are in. So we would love if everyone could, jump on Menti, maybe on your phone or on another screen, and follow along with us as we go. If you don't get the chance to grab this code right away, it will be up at the top of the screen throughout. So you'll be able to go back in there if you need to.
We'll give you like 10 more seconds to log into Mentimeter. And please do log in. I really want to encourage you to log in, as these are much more fun when everybody participates. It I think it's probably less enjoyable to just listen to me and Melissa talk for 45 minutes. So we want to hear from you. We want to know what you're thinking on these topics as well, and share some of your insights as well. So if everybody's hopefully logged in, let's do a test question just to make sure that this is working as well.
Yeah. And you will see here the code is still there at the top, but there's still a QR code here. So you can answer this first question for us. How comfortable are you with investing? Okay, this is interesting. So far, it looks like there are quite a few of you who are quite comfortable, very comfortable. We have a couple down in the fairly uncomfortable, or even one absolutely terrified, and that is fine. We know that this can be an intimidating topic for many, and that's part of what we want to do today is make it a little bit less intimidating for all of you. So we do seem to have a kind of a nice range, but interesting that we have quite a few people who are comfortable. So we will be going through a lot of the basics today, but of course we will try to answer your questions as we go as well. So we'll just give it another couple seconds if anyone else is still just getting set up here and wants to get their answers in. But it seems like we're pretty much paused, so I think we can
Okay,
move on.
let's keep it going. Here's our agenda for today. So we're going to cover 4 main topics. The 2 middle ones will be where we spend most of our time today, but we'll take a quick second and touch on what you need to think about and where you want to be with your finances before you even start investing. Just really like kind of what you need to have in place before you start looking at investing for the long term. We're also going to touch on why you even need to think about investing in the first place. Why is this important? Why does it matter? Then we'll do a deep dive into how investing actually works and some of the common strategies that are out there for you to consider and how you can go about being successful with your investing. And then finally, we will touch on, assuming that you're ready to get started, if you haven't already, how do you go about actually getting started? So with all of that being said, that's our agenda. That's all of our housekeeping. Let's dive in. And so I will start with topic number 1, which is what do we need to think about before we even start investing? So before we get into, researching which stocks we want in our portfolio, in my opinion, we want to have actually these 3 items that I've listed here. We want to take a look at these first. So before we start investing, we want to ensure that we have any high interest debt, like a credit card, completely paid off and down to 0. We also want to have enough cash saved to fund our short-term goals. So if you know that you are going to need to buy a car soon, or you've got a vacation coming up, try and get the cash that's going to go towards those things in place first before you start allocating money into a long-term investment account. And we are also big advocates of having an emergency fund in place. So the rule of thumb that a lot of people use is something like 3 to 6 months worth of expenses. Now, the reason that I'm advocating having these items crossed off of your list first before you started allocating towards long-term investments is because when we're going to allocate our funds, we have to think about where the money is going to work the hardest for us. So if, for example, if we're going to assume that we're going to make something like 7 to 8% per year on average investing in the stock market, just as an estimate, it doesn't make sense for us to invest instead of paying off a credit card where we're paying 20% or more in interest. The money is actually working much harder for us if we pay off the credit card. And so you'd rather do that before you start investing. And so that's the key question that you have to ask yourself when it comes to a credit card or really any debt. So if you have lines of credit and things like that, this is also worth considering.
And
The
there
question
is
you
a
have to ask.
question. Sorry to interrupt you, Phil. There's a
Perfect.
question in the chat says, does a car loan at 7% count as high interest debt?
Literally beat me to the next point that I was going to make. I think that the key question that you have to ask yourself is, do I expect the return that I'm going to get from investing in the stock market? Is that return going to be higher than the amount of interest that I'm paying on debt? So for Taste, for your question, if you've got a car loan at 7%, paying off that car loan represents a guaranteed return of 7% per year after tax. So in my opinion, that's a pretty attractive rate of return to get as a guarantee. And so in the case of 7%, in my opinion, I would probably pay off the car loan before I would start investing in the markets. And then once the debt is paid off, once you have an emergency fund in place, once you've got cash in place for your short-term goals, then you are now ready to start investing for the long term. Now, the emergency fund, this is another just key quick point on this. The emergency fund, which you're going to hold in cash, is going to be expected to have a lower rate of return than what you expect to get from your stock investments. So high interest savings account rates are pretty nice right now, but over the long term, we'd expect you to earn less from your emergency fund than from an investment in a portfolio of stocks. But the reason that you still want to have that emergency fund in place, even though it's going to earn a lower rate of return, is so that you don't ever have to borrow on something like a credit card. So the cash, you're holding it not for the rate of return that it gives you, but you're holding it for the interest that it helps you avoid having to pay by carrying a credit card balance in the future. So hopefully that makes sense. Again, these are the things that I would be considering before we look at starting to invest for the long term. Once these things are in place, then you're ready to get started with investing more for your long-term goals. And Melissa, I'm going to hand the ball over to her, and she's going to explain why you even need to then start thinking about investing. Why does this make sense?
Okay, fantastic. Yes. So as Phil mentioned, if you have those other steps checked off already, you might be thinking, okay, what are the next steps, and should I be investing? Why would I want to take risks with my money? There are some really good reasons to do so. So, one of the big reasons is that you need to have money available later on in your life, such as in retirement, when you no longer have an income coming in. So, I will just clarify that when we're talking about investing, we really are talking about investing for the long term, for these long term goals. So, often for people, retirement is one of the big ones. Most of us don't want to work forever. Even if we do, our health might not allow for it. So we do have to have some money set aside for when we no longer have that income coming in. And of course, as we've really felt over the last couple of years, especially, things get more expensive over time. So we've all felt those impacts of inflation. And we're going to talk a little bit more about that just over the next few slides, that it is important that our money beats inflation so that we can continue to buy the things that we need.
I'll take a quick second just to, before we move on, Andy posted a question in the chat as well. Am I better off holding an emergency fund in a TFSA mutual fund or in a savings account? So quick distinction for you, Andy. The TFSA itself is not an investment. A TFSA is a bucket that you could hold either a mutual fund or a savings account inside of. With your emergency fund, you generally want to hold that in something that is safe and not going to drop in value before you need the money. So something like a savings account or a cashable GIC. And if you have the TFSA room available to shelter any interest that either your high interest savings or GIC earns from taxes, then for sure you could hold your emergency fund inside of your TFSA. So that's a good question though. And thanks for letting me take some quick time to answer that. Let's keep it moving.
Absolutely. Yeah. Keep the questions coming. We love to get the questions, and we'll do our best to get to all of them as we go through. So, as we were talking about, one of the big reasons why we invest is we are trying to outpace inflation. So, things are becoming more and more expensive all the time, and we want our money to work for us so that we can continue to afford what it is that we need. So, just as a visual representation here of inflation and how that's impacting what it is we can buy, if you look back in 1918, a whole quart of milk you could buy for 14 cents. 50 years later, that same 14 cents would only buy you one small glass of milk. And then to, more nowadays, to around 2018, you could only buy 6 tablespoons of milk for the same amount of money. So clearly, we're going to need our money to grow, to work for us, if we're going to be able to continue to buy the things that we need and afford our quality of life. And again, I think that, over the last couple of years, we almost don't even need to show you this, because it almost feels like that's happening just within a couple of years. So we've got another question for you that you can answer through Mentimeter. Again, if you weren't here at the beginning, you can go on to menti.com, put in that code that you see at the top, and answer this question for us. Things have become 7 times more expensive since 1970, so approximately the last 50 years. How much do you think that stocks have grown over that same time period? So over about the last 50 years, and we're talking about the global stock market here, in case you're wondering. So yeah, we have a few different answers. We'll give a couple more seconds as answers come in. We seem to have people giving all sorts of
All
answers.
over,
So
we're spread all over here.
yeah,
Yeah.
7 times would mean that we're just keeping up with inflation. Or are we outpacing inflation? Have they grown by 20 times, 100 times, 150 times? We seem to have quite a few people kind of clustering it more in the middle here. So why don't we go ahead and see what the answer is? So global stocks have grown by actually not even 150 times, but even more than that, 160 times in that time period. So I think this is a really nice way here to see how much growth in the stock market has outpaced inflation. So the blue represents inflation. Things have become 7 times more expensive in the last 50 years, but the stock market has grown 160 times. So if you had invested $1 in the global stock market back in 1970, it would be worth $161 today. So even though things have become more expensive, you would still be able to buy a lot more if you had invested your money. So like we said, this is a big reason why it is important to invest for the long run. We're not talking about, in the next year or two, but for the long run, so that you can not just keep up with inflation, but actually outpace inflation and have what it is you need. So we're going to ask you a question here that's a little more personal. So this one does not have a correct answer like some of the other questions that we've had. This question is, how much money do you think you will need to save in order to retire? And wow, okay, we've got everyone so far. Okay, we've got a couple of different answers here. Quite a few of you think that you're going to need over $1 million. Again, there's no right or wrong answer. It's very dependent on your own circumstances. So we'll give another few seconds, see if we get any other answers. No, everybody
Almost
everybody seems
everyone.
to
Yeah.
be clustered here around the 1 million plus range. Okay, so that tells us a little something about all of you and about maybe, the kind of lifestyle that you desire in retirement. So I am going to reiterate here, this chart it's just a rule of thumb. Okay, so this is just kind of a rough guideline of how much you might need depending what your desired income is in retirement. So if you're someone who you don't think you'll need to spend very much in retirement, your desired income is only around 24,000 a year. For a couple who is currently 28, planning to retire at 65, you wouldn't necessarily need to save anything because you could live largely off of your Canada pension plan and old age security benefits. However, that does not seem to apply to most of you based on the kinds of answers that you were giving. You're probably expecting more of a middle or a deluxe kind of income range for your retirement. And based off the responses, many of you probably want a desired income, somewhere closer to the 100,000 a year range. So you are going to have to be, saving and investing some money along the way in order to have enough saved up by retirement. So this gives you kind of a rough guide of how much that might be. We're going to focus in on this middle range. If you're someone who has a desired income in the middle range, you're going to need to save somewhere between $250,000 to $750,000 before retirement. It means that you'll be putting aside $200 to $550 a month if you were doing this consistently from age 28 to 65. Now, in reality, you're not necessarily going to save the exact same amount every month throughout your life. But let's just take this as an example. Let's say you're part of a couple in that middle range. You decide you're going to set aside $500 a month to go towards your retirement. What will happen depending on your returns? Well, if you only have returns around 0%, so let's say you're just shoving the money under your mattress, you'll end up with just around 200,000 when you come to retire. If you put it into high interest savings or GICs and get returns somewhere around 3%, you might expect just over $400,000 when you retire. Whereas if you invest that money and get returns around the 6% range, you'll have over 800,000 by the time you retire. So it's going to make a huge, huge impact on your retirement, on the level of income that you're able to have in retirement, depending where you put the money and whether you invest the money. I'm just checking to see if we have any questions here
Nope,
in the
it looks like
chat.
we've got just a comment from DJ that says these are numbers if you want to retire at age 65. If you want to retire earlier, you will need even more, which is absolutely true.
Yeah, yeah. And again, just, saying again that, this is all really rough guidelines. Everybody's situation is going to differ. And this is really something you need to consider, for yourself, talk to your partner if you have it, something you're going to have to update this plan as you go. And these are the kinds of things that are good to talk to a financial advisor about as well, if you really want to narrow in on how much you should be saving and how much it is that you might need depending on your goals. But just, as that rough guideline, more so just to show how important it is to invest, so that, you have that money working for you.
Yeah, it makes a big difference for sure. So with that, let's move on and let's actually talk about investing in the markets and what that means. And so, yeah, I can see people typing their answers in. I want to get a sense from the group about what the first thing is that comes to mind for you when you think about investing in stocks. And so just to highlight some of these answers here, up and down, patience, currency conversion fees. That's interesting that that's the first thing that comes to mind. I don't think I've ever heard that one before. Fees, long-term growth. A few people have said growth. Bitcoin. I love that someone said that. I wish I didn't check every day the market is open. Yeah, I think that's a pretty common sentiment for sure.
It can be hard to ignore sometimes.
Yeah, I like someone said confusion. So I think our hope today is to try and help alleviate at least some of that confusion. These are all great answers, though. I love this. I always love getting perspective, again, particularly on how everybody feels and some of the first things that come to mind. And so hopefully some of this information today, for those that, said like confusion or, navigating the ups and downs, hopefully this helps a little bit with that. And so for this section, there's really two main points that I'd like to make, or two main aspects of investing that I would like to cover. The first is what stocks and bonds actually are. Like, I think we take it for granted sometimes when we say, oh, investing in the stock market or investing in bonds, that everybody knows what that means and knows what we're actually talking about. If you're that person who would be afraid to raise your hand and admit that maybe you don't understand exactly even what that means in the first place, this section will be for you. And so, and then the second part is, how then do we ensure success with our investments? We're probably all aware of the fact that, and people wrote it, stocks go up and down in value. Some stocks do poorly and drop in value. In order to be successful, we need to ensure that we have good stocks in our portfolio that are going to have strong performance. And so we'll talk about why that is and how you can think about trying to ensure that that actually happens, that you have those stocks in your portfolio that are going to actually do well. So let's start by talking about what a stock actually is and what a bond actually is. So stocks and bonds are used by companies to raise money to fund their various business operations. So if a company wants to launch new products or hire staff or expand their operations overseas, or maybe acquire another business, all of the things that companies like to do, they may not have enough cash just sitting in their bank account to do all of those things. And so what they do is they issue stock or bonds to people that want to invest in their company in order to raise cash. Now, one helpful way to remember the distinctions between these two different things is to remember the phrase that you can either be an owner of a company or a loaner to a company. So you can be an owner or you can be a loaner. And so let me break this down for you. Let's pretend that you have a friend who is going to start a coffee shop. Now, I don't actually know anything about running a coffee shop or how that works, but I've assumed that if you were going to start that business, you would need to buy some equipment, you would want to hire some staff, and you would probably need to start marketing your business. So one way that your friend could do this to start their business is by issuing bonds. Let's start there. So when you buy a bond, what you're doing is you're giving your friend a loan to start their business. You are a loaner. And so the way that it works is you're going to lend them your money and they are going to pay you back the loan over time plus interest. So to make money on this investment for you, they just need to make their payments. You're going to get all of your money back. And the interest that you earn on that bond is going to represent your investment return. That's how you make money when you're investing in bonds. And it doesn't really matter with bonds if the company is doing well or doing poorly, as long as they have enough money coming in to make all of their loan payments and actually pay you back, you're going to get your money back and you're going to get the interest that they owe you. If the company does really, really well, they don't have to pay you more. They just keep making their loan payments. If the company does poorly, again, as long as they can make their payments to you, you're going to be fine. So you don't really participate in the upside of the company. You don't participate in the downside. You collect your money back plus the interest. That's how you make money on bonds. So with bonds, you're giving out a loan, you're a loaner. The other option would be your friend might say, instead of a loan, I'm going to issue you some stock. And so what stock is where you are actually buying some ownership in the business. You are an owner. You get to actually own part of the company. And so with stock, the way that you make money is if the business is going to do well, you as an owner of that business get to participate in that growth. So if your friend starts their coffee shop, things are going well, revenue is increasing, maybe they want to expand the business. Maybe they want to open up another coffee shop in a different city. Maybe they want to franchise. As they acquire more assets, as their revenue grows, the business is going to become more valuable. And so those shares that you own in the business are also going to become more valuable. So unlike a bondholder, you actually get to participate in the growth of the business. Stocks have that upside potential and have historically provided a much higher rate of return as a whole than bonds. But the flip side is that you also participate on the downside if the business does poorly. So there tends to be a little bit more risk with stock because you do participate on that downside. But what we've seen historically is that stocks have, because of that additional risk, have provided a higher rate of return historically than bonds. And so it's not a matter of you should only invest in stocks or you should only invest in bonds. It really does depend on your risk tolerance. In most cases, you probably want to have a bit of both in your portfolio. But that is at a very high level what a stock is and what a bond is. We're going to take a quick pause here to see if anybody has any questions to post in the chat. Hopefully that was all clear. But if you do have any questions, we'll take 10 seconds to give you a chance to throw something into the chat.
Really wish I had more coffee right now. So we're talking about this coffee shop.
Yeah, no kidding. Okay, it looks like we're all clear on that then. So let's keep moving on. So now that we understand what a stock is and what a bond is, let's talk a little bit about how we figure out what investments we actually want to include in our portfolios. So I'm going to focus this section a little bit more on stocks, just because it helps illustrate the concept a little better. Now, the reality is that historically, most stocks have actually been poor investments. In a somewhat recent study, and that's what I have on that's what this chart is showing here, they actually looked at over 14,000 different stocks that made up the US market from 1989 to 2015. And only about 20% of those stocks accounted for all of the gains that were made by the entire market. So another way to say that is 80% of the stocks over this time period had returns of 0 or worse. They made no money or they lost money. Now, as I say that stat, you might find that to be a little bit surprising because a few slides ago, Melissa just showed you a slide that said that the global stock market has multiplied by 161x over the long term. So how can that be possible? How could it be that most stocks lose money, but as a whole, the market makes money? Well, let me explain. The reason that this is possible is because of a concept that's called skewness. The idea behind skewness is that the overall average return of the stock market as a whole is largely driven by only a small percentage of the stocks in the overall market. And so for you to be successful as an investor and to capture the positive returns from the market, you must ensure that you own the stocks that are actually going to be the winners. You have to find them among the sea of losers that are out there and ensure that they're included in your portfolio. So let me give you a bit of an analogy to illustrate this further. The task that we have when it comes to finding winning stocks is like entering a room with 100 people in it. And we're going to pretend that this room is like a fancy party because the average net worth in this room is $2 billion. Okay. And so I'm assuming I'm not in this fancy party. I'm on the outside, but you're about to enter into the room. And before you go in, I'm going to give you a task. The task is that you have to find someone in this room that has a net worth of at least $1 billion. Okay? So 100 people in a room, the average net worth of the people in the room is $2 billion. And all I'm asking you to do is find one person that has a net worth of at least $1 billion in this room.
Feel free to throw your guess in the chat here.
Yeah, exactly. Who among
39.
these nameless, faceless people is the billionaire? I think you would intuitively think that this would be a pretty easy task because the average net worth of the people in the room is $2 billion per person. So shouldn't you be able to just kind of grab anybody at random and assume that most likely they're going to be a billionaire? James has a guess that it's 3 out of 100. You're close, James. See, the problem is this becomes a challenge, a very big challenge, if Elon Musk is one of the people in this room. Because when we looked this up anyway, Elon Musk's net worth was about $200 billion. So if he is in the room with 100 people and the average net worth is $2 billion, that will actually be the case if every other person in the room has a net worth of 0. If Elon Musk is in the room, his net worth is so high that he is skewing the average net worth in the room up to that $2 billion. So again, this is the idea of skewness. It's a single data point that has a massive impact on the average. And so to bring this back again to the stock market, the challenge for us as investors is that only a small percentage of stocks are going to do well enough to actually skew the entire return of the market and make it positive. So we as investors have to find those stocks, the Elon Musks in this case, that are actually going to drive returns forward. And so hopefully that analogy is clear. I think the next logical question that comes out of this is, okay, so how do I do that? How do I actually find those winning stocks? How do I ensure that they're in my portfolio? Like, do I go and hire some financial advisor that has a crystal ball that can accurately predict which stocks are going to be the winners? Or what about the people that I see on business news with their like multi-screen computers and fancy charts and that sort of thing? Are those people able to predict the future and find the winning stocks for me? We are going to tell you the answer to that question. But first, we do have another question for you, which is, what are you currently doing as part of your investment strategy to try and have those winning stocks in your portfolio? Are you picking stocks yourself? Are you buying things like index funds and mutual funds, which we will, if you don't know what those are, we will explain what those are in a minute. Do you have someone that you're paying to do that for you, like a financial advisor or something along those lines? Or maybe you don't have a strategy at all. Like maybe this isn't something that you've started on. And if that's you, that's totally fine too.
If you're
and we have an other.
Yeah,
we were hoping we were going to get another. So in other, whoever, can you put in the chat what other is? Like we wondered if you were, throwing darts at a board or something along those lines. Please tell us what your other strategy is.
Maybe not investing in stocks at all.
Yeah, and that may be the case for some people, certainly. It looks like most people are invested in index funds. So I think there's going to be some alignment here with this next section, but let's keep it moving.
Yeah, it could just be not understanding the definition yet, not really sure yet what you're doing. So that's kind of an interesting point that maybe as we go through this, it'll be a little bit clearer what are you doing if you're not too sure about it yet. So we're going to talk a little bit about these two main strategies of active versus passive investing. And going back to that example that Phil was just showing you of the room full of people, and there's Elon who's skewing the average. If you think about it, you have to hold, those great stocks, those few great stocks in order to benefit from the returns of the market. So how are you going to do that? Are you going to hire someone, which would be the active strategy, where you're going to hire someone who's going to try to find those winners for you? And they're going to charge you for it. Of course, there are going to be some fees involved with that. Or will you follow a passive strategy where you just say, okay, I'll take all of them. I'm just going to own everything. That will ensure that I have those winners there. There are going to be the losers in there as well, but I will benefit from those returns of the overall market without having to pay someone to do it for me or to have to try to time the market. So these are the two main strategies, and I think we had a bit of a mix in our audience as well. So we're going to go in a little bit more into what does the research show us about these two strategies if we compare them, how do they perform over time? And I do think that we have someone, yeah, we have someone in the chat just said, I guarantee I can buy the best performing stocks by just buying them all. And that
Evan,
is
you can kind of
exactly
see where we're going with this,
yeah,
Evan.
yeah, I think so. I think so. So that's what we would refer to as that passive strategy. So another question for you, and I'll just mention again, you can go on to menti.com, put this code in if you're joining us a little bit later. Our question to you is, what percentage of active managers beat the markets over a 10-year period in the US? And you can put your answer in anywhere along from 0 to 100%. What percentage of active managers do you think beat the market over a 10-year period? So we have a few clustering down low on this scale. We have some that are a little bit closer to the middle, not too many though, definitely clustering down at the bottom. Don't be influenced by everyone else. Put in, okay,
Oh,
we've got
good. Someone was
100%
bold and went
there.
100.
Okay,
Nice
there
job.
we
I
go.
like
See,
that.
don't be afraid to step outside and go against the grain. All right, so we do have kind of a mix. The answer is 2%. So I think we actually had someone may have guessed bang on there at the 2%. So the longer the time horizon, the lower that percentage is. So this shows you that over a 1-year period, it's somewhere in the 30 to 40% range of active managers that will beat the overall market. But you can very clearly see that as time goes on, as you get into 3 years, 5 years, 10 years, that number drops more and more and more. So it's very hard, even if you're someone who is, actively beating the market early on, maybe you have a really good year or 2 years or 3 years. What are the chances that that is going to continue over the long run? It's pretty low. And you can see on this chart that, it's different depending on whether we're talking about Canadian equity, US, international. But by the time you get into that 10-year, that longer term period, it is very low. So the evidence shows us that the chances of an active manager outperforming the market are very low over the long run. And I think that's really where, most of us are investing over the long run. So that's what we're very concerned with. So just to illustrate this a little bit more, why is that? Why is it that active managers have such a poor track record? Well, who is this? Anyone know who this is? This visual here. I'm sure there's some of you. Some of can throw it in the chat if you know. So this is LeBron James playing LeBron James. I find one of them is easier to see, one that's a little harder. So this is a visual of LeBron James playing basketball against LeBron James. Who is going to win in this situation, if I ask you? Which of them is going to win this basketball game? Well, it's the same person with the same amount of skill and the same amount of talent and teams behind them. So it's really just a roll of the dice. It's completely up to luck who is going to do better or who is going to win this game. It'll come down to something really random, like a fly flies into one of their mouths or something like that, right? And if they continue to play against each other in game after game after game, it's just going to go back and forth of who is going to win. So we use this as an example to show what active managers are up against. Because you can have an active manager who is highly skilled, educated, has a great team behind them, access to the best technologies. But who are they up against when it comes to trading and picking stocks? Other people like that as well. They are all very skilled and they are all up against each other and trying to beat one another when it comes down to, what they're going to do and how they're going to perform. So it is very, very difficult to do this over the long run. And the fact that you have to pay these people, so LeBron James is not stepping out on the court for pennies, right? So someone who's highly skilled, highly talented, they're going to demand a lot of money for what they do. And those fees are going to impact your returns pretty dramatically over time. So this graph here shows you what the impact of those fees could be. So you can see the green line represents about 2.2% fees, which is pretty common for actively managed mutual funds in Canada. Actually, as Canadians, we pay some of the highest fees on mutual funds. So I wouldn't be surprised, if there are many of you out there who are paying, around that much in fees. The red line represents 0.25% cost and the blue line, no costs. So you can see a dramatic difference in returns over time. This is over a 30-year period, especially between those 2% fees or those much lower around 0.25% fees. You, at the end of that 30 years, if you've started with $100,000, if you're paying the higher fees, you'll have under 300,000. And if you're paying those lower fees, it will be over 500,000. So think about the impact that that's going to have on your life, on your retirement, on your desired income when you get to that stage. The fact that these fees are so high on actively managed funds is a big reason why it's not going to outperform in the long run. Did we have any other questions coming in? I think mostly comments so far.
Mostly people slagging active fund managers.
Okay, all right. Well, they're with us then. That's good to know. So we are going to talk a little bit more about the passive strategy. We've told you that, active investing, that strategy does not outperform over the long run in most cases. Fees are high. What is the alternative? Indexing. And I think we already saw that a lot of you invest in index funds. So this is following the passive strategy where you say, I'm just going to hold a little bit of everything. Going back to that Elon room example from before, you're not going to go and try to pick out who the billionaire is. You're just going to own all of them and you're going to benefit from that overall growth in your portfolio. An important part of this is that you're not trying to time the markets. So I think someone mentioned in the comments earlier that they try not to look every day at what's going on. Yeah, it's a good idea to not pay too much attention to that noise, because when people start trying to time the markets, trying to figure out, when is there going to be a recession and when are stocks going to crash, that's often when they miss out on a lot of the returns. So if you want to benefit from those returns that we've been talking about, that we showed you earlier on, how the global stock market has gone up 160 times over the last 50 years, if you want to benefit from that, you need to be holding throughout all of these scary periods. And I do know that that can be tough because there's news, there's noise, there's social media, there's your buddy down the street who's telling you the recession is coming, but you just buy and hold. You just say, I'm going to own the whole market and I'm just going to hold on to this for the long run. One of the benefits of that is that it will minimize costs, like we were showing you. And ultimately, you get to benefit from the returns of the market. The returns are coming from the market and not from the managers.
Just a quick point. So Kelsey has posted in the chat. So is mutual funds active investing? So great question. So yeah, those two terms are typically used interchangeably. There is some nuance into what a mutual fund actually is, like as far as the actual structure of the product itself. But that's generally when we're talking about active managing. In most cases, that's referring to investing in a mutual fund, where that mutual fund has a fund manager and a team of analysts and researchers all behind them. And what they're trying to do is do all this research to pick winning investments, avoid losers, and allegedly add value over the long term. But as I think we've showed, the fact that they're competing against one another and the fees tend to mean that most of them don't end up actually adding that value over the long term. You're generally better off indexing and just buying everything in the market. So hopefully that clarifies things for you, Kelsey. But
Yeah, yeah. It is
if it,
so it is possible to have a mutual fund with more of a passive strategy, but
right,
generally we're seeing an active strategy.
exactly. Okay, awesome. So hopefully that information is helpful for everyone, and hopefully now as we kind of head towards the end of the presentation here, this information has given you a little bit more confidence when it comes to investing in the markets, maybe a little bit more comfort as well, and maybe you're feeling okay, I'm ready to get started. So how do I go about doing that? Very broadly, there's two main paths that you could take. If you're the type of person that's a bit of a DIYer, so like I'm going to assume you like changing your own oil on your car or repairing things in your house as well. That's not me. I'm generally going to do more damage to my car if I try and do any type of repairs, but I know that's not everybody. Some people like watching YouTube videos and learning how to do some of this stuff themselves. So if that's you when it comes to investing as well, you can actually open what's called a self-directed investment account. Most of the big banks all offer them. There's also companies like Questrade or Wealthsimple Trade where you can open it and have at it. Basically, deposit your money, start picking investments yourself. Now, hopefully, we've convinced you with the presentation today that going in and trying to choose stocks yourself and make predictions about the future and guess which are going to be the best performers, tends to be a losing strategy. And so we would suggest, if you're going to go that route, to look into something like what we'd call an all-in-one ETF portfolio. If you Google Vanguard or iShares, these are companies that offer these types of products that are very, very popular here in Canada. And basically what they are is exactly what Melissa talked about earlier, a portfolio where you just own everything in the market. You're not guessing where the winners and the losers are going to be. You're going to own everything. You're going to own all of the winners and you're going to own all of the losers for a pretty low fee. And over the long term, the winners should perform well enough to drive positive returns from the market as a whole. And that's a perfectly fine strategy if you want to go the DIY route. The other option, of course, is even if attending this presentation today, you're like, hey, this is good information, but there's still no way that I want to do this myself. I want help with this. I want someone to guide me. Well, that's where you could look at working with a financial advisor. Obviously, we're a little bit biased, but we do recommend working with an independent firm like PWL that's not getting paid to sell you particular products, not being paid commission or anything along those lines. And hopefully the other big thing that we've convinced you of today is the fact that working with a financial advisor does not mean that you're necessarily going to have superior investment returns. If you sit down with someone and they're telling you about their fancy strategy and how they can make predictions about the future and find winning stocks for you, my recommendation is that you run for the hills on that, because while they may get lucky from time to time, over the long term, again, those kinds of strategies do tend to underperform. We are big proponents of the fact that financial advisors add value through financial planning. So things that you have more direct control over. The markets are going to do what they're going to do in the short term. We're banking on the long-term appreciation. But where we do have direct control is around things like how much are we saving? How much are we spending? Looking at our tax strategy, making sure that we have an estate plan in place. So in addition to the investing side, if there are some complexities in your life, some questions that you have related to decision making and your money, you might be a good candidate to work with a financial advisor. And so with that being said, we're going to conclude our presentation today and with an open invitation to allow you, if you'd like to book a call with me, I'd be more than happy to chat with you. If you would like to, share some details of your own personal situation, I'd be more than happy to do a one-on-one, and potentially there could be an opportunity for us to work together. But even if not, I'm more than happy to point you in the right direction. And so you can just, if you'd like to book a call, you can actually click on the link that you see on the screen there. I have saved some time in my calendar for anyone that attended the webinar today, just to ensure that there is some availability. And so I'd be more than happy to chat with you and see if there's a chance for us to work together.
And because we have a couple minutes left, don't be shy about throwing your questions in the chat. I know that today's session really focused on the basics of investing, but I could see that there were some people attending today who maybe are a little bit more advanced. So feel free to throw some questions in the chat there, and we will do our best to answer them if you have anything.
And if you're an advanced investor who's a DIYer, that's great. Like I think that's, I love chatting with people that do it themselves and getting their perspectives. Maybe you're not a great candidate to work with a financial advisor if you enjoy doing it yourself, but you probably know someone who is. I get lots of DIYers that refer their parents or family members that they know that need help, or maybe you have a spouse who is less financially literate than you. Those are all good reasons to connect someone with a financial
So
advisor.
we have a good question. Andy asks, what's the most tax efficient way to divide my ETFs? Andy, are you talking about between different registered accounts, RSPs, TFSAs, taxable accounts? Is that where your question is going?
Perfect. Do you want me to take that one?
Yeah, sure. Go for it.
Okay. So Andy, it's a great question. And actually, Ben Felix, who is the head of our research team, has done some analysis on this. What you're asking about is a concept that's known as asset location. And if either Kelly or Louis can maybe quickly grab Ben's white paper, I think there's two of them actually on asset location. Basically, the question is, should I hold certain types of investments in certain types of accounts? Like a common strategy is to hold all of your bonds in your RRSP and then hold all of your stocks in your TFSA and your taxable account and that sort of thing. And so the broad answer to that question is that the analysis is a little bit tricky in the sense that it might be tempting to look at one strategy that employs asset location versus another strategy that doesn't. In some cases, asset location can look good, but in many ways, it's not exactly an apples to apples comparison. Sometimes when an asset location strategy is implemented, what's actually happening is that on an after-tax basis, you're actually making your portfolio asset allocation a little bit more aggressive than what it might appear on paper. And so that's kind of the broad answer. The general answer is and I'll even explain what we do at PWL. We generally hold the same type of portfolio across all accounts. So RSPs, TFSAs, taxable account, there's no real differentiation between the portfolios in those accounts. And that's because the research on asset location shows that if you align the portfolios in such a way that it's an apples to apples comparison, the benefit of asset location is minimal at best, and the complexity and the potential for that strategy to have to be completely unraveled if something changes in terms of tax legislation or anything like that is very high. And so we're generally not proponents of asset location, but hopefully if you want to check out the paper and book a call and chat about it some more, I'd be more than happy to chat with you more about that.
For sure. And we do have another question from Evan. I would like to refer friends and family to PWL who don't want to take the DIY approach. Is there still a minimum asset amount you require to work with someone? So we do not have a minimum asset level at this point. So what is a lot more important is the fit, whether, this is someone who's really going to benefit from working with us, who believes in our approach, our strategy that we've been talking about here. So definitely, suggest reach out, have a call. If it's not the right fit, like Phil said, we will make suggestions for where to point you in the right direction. But we would love to chat and see what we can do to help.
Yeah, I'm going to answer some more questions in a second because I do see them coming into the chat, which is great. One other quick thing, though. We would love from you, the audience, to get some feedback about this presentation. If you would like to share what you liked, what you didn't like, what was explained well, what was not. And we'd also love to hear about topics that you would like to hear more about in the future. And so again, you can click the link on the screen here. That's going to take you over to a Microsoft form. Few questions on there just to get your feedback. Please give us feedback. Whenever we get feedback from our audience, it helps make future presentations better. And it also makes sure that we include the things that you do like moving forward. So we'll leave that up on the screen as well if anyone would like to give some feedback. And then I'm going to jump in and answer some more questions. James has, what are your thoughts on a pure dividend investing strategy long term? So James, great question. Again, if Louis or Kelly want to grab on YouTube, Ben Felix has a couple of videos on dividends. And so the quick summary on dividend strategies is overall, we like companies that have certain characteristics, and often those characteristics you see in dividend payers. So we tend to focus our portfolios again on capturing the broad market, but we also want to have companies that have high levels of profitability, low stock prices relative to their book value. And a lot of dividend paying companies exhibit those characteristics. So we definitely want to include them in the portfolio. Now, there are also a lot of great companies out there that have those characteristics that just happen to not pay dividends for whatever reason. So we don't want to exclude those companies from our portfolio and take a concentrated position in dividend payers only, when there are other great companies out there that have characteristics that we like and just happen to not pay dividends. And so dividend strategies have worked out generally pretty well. A lot of dividend-focused ETFs or funds have outperformed the markets because, again, they have some companies in there that have characteristics that lead to higher expected returns. There are lots of great companies out there as well that don't pay dividends. We want those in our portfolio as well. So check out those YouTube videos. Ben explains a lot more detail about why you don't necessarily just want to focus on dividends. Did Ben Felix publish a book? No, I don't. Ben has not published a book. If you want some book recommendations, I'll just quickly rattle off a few. I know we're at time. Psychology of Money by Morgan Housel is probably the first personal finance book that I would go to. And an oldie but a goodie is Stop Overthinking Your Money by Preet Banerjee, which is the first person. It's on my shelf back there. It's the first personal finance book that I ever read, and highly recommend checking it out. Okay, you know what? We're at time. I see that there's another, maybe one question that we didn't get to. Again, if you have any additional questions, if you'd like to chat with us, please do book a call. Oh, Louis just mentioned Retirement Income for Life by Fred Fatise. Yes, also a great Canadian personal finance book that I would highly recommend checking out. Nice shout out, Louis. That's true. Okay, well, we'll wrap it up there. Thank you, everybody, so much for coming. Great to have you all here. Hope everybody has a great rest of their day. Thank you.